Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey, guys, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And I am very, very fired up to be with you today. Super, super excited. Lots of news, lots of confusing news, conflicting headlines. Is the sky falling? Is it a good time? What's going on? Everybody wants to know what's going on with rates. Everybody wants to know what's going on with real estate. We're going to cover all of that. Guys, we're also going to touch on something that might be a little bit taboo. What does a mortgage application and a colonoscopy have in common, right? We're going to talk about that, and we're also going to talk about pizza by the slice and tiny homes. So you're definitely going to want to hang in there with us this week. If you have questions or comments along the way, just call or text 855-462-7292. That is the Anytime hotline. Jen is womanning the hotline. She'll get your questions on the air. If you are surfing the web and prefer to shoot your questions over that way, just head over to mrmortgageradio.com, and you can't miss it. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. Click that button, follow the instructions. They'll pop up on our end, and Jen will read your questions on the air. But hey, let's dive right in, right? Colonoscopy and mortgage application, what the heck do they have in common? Well, to start with, they're both a pain in the butt. They can be anyway. Well, I think a colonoscopy probably always is. But where I'm going with this is the preparation for both is super, super important to make sure that it's a successful procedure. And in both cases, it's super, super important, right? In the case of the colonoscopy, you want the best possible results to make sure that you're healthy. You want to do everything he says, so you're giving him the best data to work with because your health is on the line. So most people take that really, really seriously. But the mortgage application, some people have the I'll get around to it mentality. And the prep work is equally important. And by prep work, I mean get all your documentation together, right? You know, if you're self-employed, you're going to need your tax returns. Or if you earn 1099 income, you're going to want those tax returns on hand, ready to go. Your last 2 years worth of W-2s, your pay stubs, the most recent 30 days, the most recent 3 months to be safe, all your asset accounts. And guys, I can't stress this one enough. Even the page that says left blank intentionally. I know that makes 0 sense, but on the statement, it'll say page 1 of 6, page 2 of 6, 5 of 6, and then 6 of 6 has nothing on it, except on the very bottom, it says left blank intentionally, but it's 6 of 6. We need the entire bank statement. So getting all of that documentation together up front, that prep work, if you will, can make the procedure far, far less of a pain in the backside. It really can. And it makes you a more powerful buyer because you're a more powerful borrower. And what I mean by that is you've given your mortgage company all of the tools they need to give you a full-blown approval that's just pending a property to plug into the equation. They've reviewed accurate income, accurate asset data, accurate credit data. They've got everything together that they need. All they have to do is plug in a property and they are off and running. So really, really important that in both instances, the colonoscopy or the mortgage application, for the colonoscopy, it's because you don't want to have to do that again. You want to get it right the first time. In the mortgage application, you want it to close as smoothly as possible, as quickly as possible, so your transaction is painless. So I just wanted to throw that out there. I get these obscure references sometimes, and it could be my age and the medical procedures that I have coming up pretty soon. But it just got me thinking that doing that prep work up front, and when somebody says, guys, we need this documentation, getting it immediately and not waiting until, well, I'll get that tomorrow. And then tomorrow becomes Wednesday, becomes Thursday, becomes next week. And the whole train stops rolling, waiting for that one piece of cargo to be added to it. And now you got to pick up all that momentum again. And a lot of people are still competing for properties, and they're writing very, very short close times. Well, a short close time is doable, but you're reducing all of your room for error. All of the tomorrows are gone if you're trying to close quickly. So prep work is super important in both of those instances. So I wanted to throw that out there, and I wanted to grab your attention with the medical reference. I was going to say prostate exam, but that leaves the ladies out. I wanted this to be inclusive, right? We're including everybody in the show. All right, my other vague reference was tiny houses and pizza by the slice. And this is in direct response to an article that I had written for Newsbreak. And it was about a subdivision in Texas. I believe Lennar Homes was the builder, or is the builder. I think it's about 50% built out, of tiny homes. These are 660 square foot, 2-story homes. And they're priced, at the time I wrote the article, about $160,000. The marketing around it is $160,000 is an affordable home in almost every market. But I got into a conversation with a reader, and we had a really, really interesting conversation. And if you want to check those articles out, guys, they're at mrmortgageradio.com on the bottom of the page. But anyway, we were talking about it, and is 660 square feet for $160,000 really affordable? And just to do, quick, easy math for the radio, I'm going to round down to 600 square feet and round the price down to 150 and just say, okay, that's like paying $600,000 for a 2,400 square foot house. It's really not affordable. It's just tiny. And that thought was in the back of my mind. And I was having lunch at my local pizza shop. There's a local shop here. I love them. Little hole in the wall. Some people don't like it. They're known for the $12 cheese pie. And guys, I can be cheap sometimes, and I love the $12 large cheese pie on the way home from the office. But anyway, I was in there, and the lunch special is 2 slices of cheese and a fountain drink for $9.99. So call it $10. And the fountain drink on the menu is $1.99. So call it $2. So that means I'm paying $4 a slice, right? I'm paying $10 for 2 slices and a fountain drink. Take the fountain drink out, that leaves $8. I am paying $4 a slice. The lunch special sounds special. The tiny house at $150 sounds affordable. But that large pie for $12 has 8 slices. So that's $1.50 a slice if you buy the whole pie. And I'm not knocking them. I don't begrudge them. I happily go in and have lunch all the time. My point is, don't get caught up in the headlines of things or the marketing of things. Is that really the best financial decision? Do you want to pay $160,000 for a 660 square foot tiny home? And what's the desirability on the resale market for that thing going to be in 15 years? Are we just in a weird place? Remember when the gas crunch? Well, some of you weren't alive, and I was barely alive, but I remember hearing about it, and I've done the research where you could only get gas on certain days of the week if your license plate started with an even number or an odd number. And that blip in time created the compact cars, some of which are no longer in existence. There was something created for the moment. And is the tiny house the tiny car of the 70s? So just be cautious. Just be cautious. And I love tiny homes. I'm not knocking tiny homes. I just don't know that I want to pay that amount of money to live in a subdivision of tiny homes. So guys, don't get caught up in the marketing of things. Don't get caught up in the headlines, in the presentation of them. Is the lunch special really an affordable special, or is it just convenient? You have to decide for yourself, but don't get caught up in the hype. All right, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Hey, if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline, and Jen is womanning the hotline. She'll get your questions on the air. Or if you prefer, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions. Your questions will pop up over here, and Jen will read them on the air for you. Hey, guys, and if you're just joining us, man, oh, man, you missed all the fun. We're taking down the streamers and sweeping up after the colonoscopy pizza party that we had in the opening segment of the show. If you were with us, I hope all that made sense. And if you weren't and you want to check out what all the fun was about, wait a couple days and check out MrMortgageRadio.com, because each week after the radio show airs live, Jen posts a recorded version of it with all of the commercials stripped out to MrMortgageRadio.com, so you can hear what we're talking about. Slices were flying all through that first segment. But anyway, speaking of Jen and speaking of fun, let's get right to your questions, as they are always my favorite part of the show. Hey, Jen, go ahead and throw me a question if you're ready.
Thomas sent this text. I own a few rental properties and I'm trying to buy more. My bank says I can't have more than 4 mortgages at one time. Are there any other options?
Hey, Thomas, this is a really, really good question, my man. There are other options, and let me start by addressing your bank. What they are most likely referring to is a specific guideline that they have, an overlay that your particular bank has, that they do not want to extend more than 4 mortgages to one borrower. If I'm understanding you correctly, you said they won't let you have more than 4. And that could be just a risk calculation that they have. Now, interestingly enough, there are loan programs like the landlord loan that allows you to have up to 30 loans. So if you've already got 4 with your bank and you want to buy more investment property, there are at least 26 other options out there with the landlord loan. And guys, if you're unfamiliar with that loan and you want to buy rental property, and right now may be a good time to start looking at rental property, as interest rates have crept back up a little bit and buyers have pulled back and a little more inventory is coming to the market. There might be, I don't want to say deals, because we haven't seen deals in a while since COVID, but there might be some opportunities out there to grab some properties that are cash flowing. With the landlord loan, we don't look at your personal income. We're not underwriting your job. We're not underwriting your tax returns. We are looking at your credit and your assets. So if you have adequate assets and you've got a decent credit score, and most importantly, the property cash flows, or if it's vacant, the average rents for the area will allow it to cash flow, then the landlord loan is fundable. And when I say cash flow, it doesn't even have to throw off a bunch of positive cash. You can buy a property that's maybe underperforming. The rents are a bit low, but as long as the rent covers the principal, the interest, the taxes, and the insurance to at least a 1-to-1 ratio, meaning it breaks even, then boom, that's a fundable deal with the landlord loan. So that's a very, very powerful loan program if you want to buy some rental property and you don't want to go through the scrutiny of having your personal income underwritten. It's a great opportunity. And as I mentioned, they'll allow you to have up to 30 loans on your personal portfolio, if you will. So I hope that helps. If I'm missing something or you need more specific information, just give me a call and I'll be happy to talk it through with you. But in the meantime, I hope that helps to know that there are several other options out there for you. But great question, and thank you for sending it our way. Hey, Jen, do you have another one ready? All right, go ahead.
Kenny emailed us this question. I have a mortgage on my house now and want to keep it and rent it. Can I use my VA loan to buy the new house? I've never used it before.
Hey, Kenny, this is a great question, my man. I'm going to make a few assumptions, but if you've been in your current home for 12 months and you've got a conventional loan, right? You said you've never used your VA loan, so I'm guessing you have a conventional. Then you can keep it rented out and buy the new property with the VA loan. You can do that even if the current property has an FHA loan. Where it gets a little bit sticky is if you had a FHA loan now, right? If you had an FHA loan now and you were buying another FHA property, and I know you've got a VA loan, but I want to address this for anybody out there who's considering this, right? There's what's called the departing residence rule. And the departing residence rule states that if you have an existing home with an FHA mortgage and you want to go buy another home but keep the current home and rent it out, there has to be at least 100 miles. I believe it's 100 miles or 1 hour commute. I think it's 100 miles between the two homes. If that's the case, then you could keep your current FHA loan in place, rent the property out, and go buy another property. Now, there are other stipulations and conditions that have to be met, but that's the big one, the departing residence rule. Now, going from a conventional loan, keeping the property, renting it out, and then going and buying a VA, you're going to be fine. So I hope that addressed your question. And guys, that is a great option. Buying a property, and even if you bought it with an FHA loan, let's use that first example, and you refinanced it into a conventional loan or refinanced it into an investment type loan, because now you've got equity and you can go buy your primary with an FHA. Or if you had a VA, refinance it into an investment loan and then take the equity cash out and go buy a home with your VA loan. It's a brilliant opportunity to house hack your way to an investment portfolio. And you see people talking about it all the time. Just know that you've got to live in the property for typically 12 months. And if it's a multifamily property, you still have to live in the property. And you hear me harp on that all the time. People are out there wildly misrepresenting the Fannie and Freddie guideline change of November 2023 to imply that you can put 5% down on an investment property. That's not how it works, guys. You can put 5% down on an investment property if you choose to make one of those units your primary residence. And you got to be super, super careful not to be tempted into saying it's going to be my primary and never intending or never moving into it, because then you've committed occupancy fraud. And guys, occupancy fraud is as innocent as it might seem, is mortgage fraud, and mortgage fraud is a felony. So don't be tempted into taking advantage of the system or cutting corners or nobody ever gets caught. That's all a bunch of BS, guys. Occupancy fraud is mortgage fraud, and just be cautious not to get caught up in the moment. So I wanted to throw that out there. But I hope that answered your question. If you need more info, you know how to reach us. I'm always happy to jump on a call. Hey, but you hear the music, guys. You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are locked and loaded right here on the Mr. Mortgage Show. And we greatly appreciate you choosing to spend a bit of your day with us. If you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Or you could head over to mrmortgageradio.com. That's mrmortgageradio.com. And right in the middle of the page is a big orange button. If you click that button, follow the instructions. Your questions will pop up on our end, and Jen will read them on the air for you. But hey, guys, we've had some good questions so far, and let's keep them rolling. Hey, Jen, do you have another question? All right, let's go.
Here's a question from Lisa. My dad says he'll help me buy a house, but he doesn't want to be on the mortgage. Can we do this? What are the steps?
Hey, Lisa, this is a great question, and congratulations on having a very cool dad who's willing to help, because right now there are a lot of people that can use their parents' help in getting into that first home. And it's not surprising, to me anyway, to see how many parents are doing that because they've got all of this newfound equity. Most people never dreamt their house was going to be worth this much this quickly, and some parents are more than willing to help their kids with a little bit of equity extraction of their primary and gifting it to their children. So this is doable even if your dad doesn't want to go on the mortgage. So I'm going to talk you through both ways just in case somebody out there listening is either a parent who is willing to go on the mortgage or someone who does have a parent willing to go on the mortgage with them. So we'll cover both. But to answer your question first, if he doesn't want to be a quote-unquote co-signer, then he can gift you the money necessary for the down payment and the closing costs. And you might be saying, well, wait a minute, Mark, there's only a 3.5% down payment required. Can he gift me more money if he wants to? Yes, he can gift you as much money as he would like. And some parents do that. They'll gift a large amount of money to get the loan amount down so the payment is manageable. So gift funds are a great strategy if a parent wants to help a child but doesn't want their credit tied to the mortgage, if that makes sense. Now, that assumes that you have the credit on your own and the income on your own to qualify. And if that's not the case, that's where co-borrowers typically come into place. And a co-borrower in the mortgage world is considered a non-occupying co-borrower. And a non-occupying co-borrower acts just like a co-signer in any other world, but we're just going to make them sound that much more official in the mortgage world. Non-occupying co-borrower. Now, with the non-occupying co-borrower, you use both your incomes, both your credit scores, and both your asset pools, if you will. So all of dad's assets, all of your assets are underwritten together, just as if you were buying this to move in together as two people buying a property. He's just a non-occupying co-borrower, and that allows you to lean on his income and lean on his credit if you don't meet the requirements on your own. And in that instance, his credit score is all tied to the mortgage, just like yours. He's 100% responsible, and you're 100% responsible. A lot of people are mistaken. They think, well, I'm only a co-borrower. If one person doesn't meet the obligation, the other is 100% responsible for it. So he's going to have to take that into consideration if he wants to buy something in the future, because he's got extra steps to be underwritten for the mortgage he's co-signed with you. And I can walk you through all that. I know that's not your scenario, but I wanted to share that because right now a lot of people are getting help from their parents. And those are the two major ways: non-occupying co-borrower and gift funds. The other way is a little more obscure, but we're seeing parents actually buy the property and lease option it to the children. So they own the property in their name. They're in full control of the payments being made, if you will. And the child is leasing it from the parent with that option clause to buy. So we've seen that as well. It's not nearly as popular as the other two strategies, but buying a property and lease optioning it to your child until they're mortgage ready is another strategy to help get your kids into that first home. So great question. I love talking about this, and where we are in the market right now, a lot of people could use this help. So I'm glad that we got a chance to talk about it. Hey, Jen, do you have another question?
Rex sent this one. We talked to a reverse mortgage company about a year ago, and they gave us some estimates. We just talked again this past week, and they're telling us available equity is lower. This doesn't make sense to me. Feels like a bait and switch. Will you share your thoughts?
Hey, Rex. No, I don't think it's a bait and switch. There are only a few things that control how much equity you have available to you with a reverse mortgage. One of which is your age. The older you are, the more equity you have access to. So that's gotten better, right? You've gotten older. You mentioned it was 18, 24 months ago. So you're older now. So that's not the problem. The other key factors are the interest rate of the day and your home's value. So is there a chance that your home is worth less today than it was 18 months ago? I mean, by and large, the nation has appreciated, but there are pockets that are seeing pullbacks. Some second home markets in our practice areas have pulled back around 15%. So if your property values have softened a little bit, you're going to have access to less equity now. Or what's most likely happening is the interest rate is higher now than when your proposal package was originally prepared. And the higher the interest rate, the faster that loan balance will grow and eat more of that equity. So to hedge that, the bank offers less equity up front. So it's likely one of those three things and not a quote unquote bait and switch. And guys, that's one thing to be aware of. If you think property values are going down and you're going to do a reverse mortgage in the future, sooner rather than later might be the right move, because once that loan is in place, they can't take that equity away from you. That's your money. Even if values plummeted, they couldn't take that equity away from you. So a lot of people don't realize that. They think it acts like an equity line of credit that can be adjusted to market conditions. And that's another thing to consider. Some people go the equity line route, which involves a monthly payment. The reverse mortgage doesn't have a monthly payment. There's one big payment at the end, but not a monthly payment. But some people are so concerned with eating up the equity, quote unquote, that they'll go the HELOC or home equity line of credit route. But if the market softens and values go down, they can change the availability of equity and sometimes close the equity line out altogether, which happened pretty routinely in the housing crash of the early 2000s. So, but great question. Great question. I welcome the opportunity to talk and run a fresh proposal package for you. If you have any interest at all, just reach out to us when we are off the air, and I'll jump on the phone and see if we can't run the numbers together. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
We're back. Hey guys, this is Mark Eitel, and you are listening to the Mr. Mortgage Show. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline, and Jen is womaning the hotline. She'll get your questions on the air. Hey guys, we call it the Anytime hotline because yes, it rings right here in the studio while we're live on the air. but it also forwards to my office the rest of the week. So if you need us when we're not on the air, that's also a great number to have handy, 855-462-7292. Or you can always head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says get your questions on the air. Just click that button, follow the instructions. Your question will pop up on our end, and Jen will read it on the air for you. But hey, let's get right back to them. I know Jen's got some questions back there, and I am ready to rock and roll. So, hey, Jen, throw me a question.
Andy sent us a text. We are in contract to sell our home. The buyer's bank is telling us the appraisal is low and they're no longer approved. Is this right? Why would the bank care if they pay more? I appreciate you explaining this if you can.
Hey, Andy, thank you for this question. This is a really, really good question. And I know it can be super frustrating for both the buyer and the seller, but especially for the seller because you're wondering what the heck's going on here. It's unlikely that they're no longer approved. They just may not be approved for the same loan amount. And what I mean by that is every loan approval is based on a percentage of the purchase price or the value of the property, whichever's less. So, for example, if you were selling a $500,000 house and your buyers were approved for an 80% loan, they're putting 20% down, they're approved for a $400,000 loan. Now, that might be their max based on principal, interest, taxes, and they may not qualify for any more than that. And they might only have that $100,000 plus their closing costs and reserves to make the deal happen. So if the property appraises for $475 and do quick math, they're now going to get a $380,000 loan. In order for that deal to work, they're going to have to come up with $120,000 plus their closing costs. So it sounds more likely that they're no longer qualified because the loan amount changed. I hope that makes sense because the bank doesn't care if they pay more than the property's worth. You know, if that was the case, the majority of the transactions during COVID would have never happened. So that's not the bank's concern. Based on all of that, what is likely the culprit is the additional monies out of pocket to make the transaction work, maybe where they're falling short, and therefore the bank can no longer write the approval. I'm guessing that's what it is. If I'm missing something and there's more details you'd like to share, feel free to reach out. I'll be happy to talk with you. Great question, though. I appreciate that one. Hey, Jen, throw me another.
This one is from Rudy. I have good income and can put down a large down payment, but my credit score is still banged up from my divorce. What is the minimum credit score to get any type of mortgage? I've heard about a hard money loan, but don't know if that is what will work for me.
Hey, Rudy, this is a really, really common question. It's interesting because it's not always the credit score that's the challenge. It's what's on your credit that is disqualifying you from eligibility for a particular program. So to answer your question, with a VA loan, you can go all the way down to a 550. And I know some people out there advertise a 500, although, you know, I've not seen that happen. But, you know, 550 is probably a realistic bottom for VA, and then 580 for a manual underwrite FHA. Now, you said you've got a fair amount to put down, so just know that going in, even with an FHA loan, the lower credit scores are going to require more than just a 3.5% down payment. So hard money is an interesting conversation because hard money is all risk mitigated based on loan to value. You've got to put more money down. They're loaning you a lower percentage of the value at a higher interest rate. So, and they're not underwriting to any quote unquote guidelines. It's the individual investor's choice if they want to do the transaction. But anyway, my point is, I don't want to get sidetracked on that. And if anybody out there is confused, hard money is like a private lender. You know, Uncle Louie without the mafioso music in the background. It's a very legitimate access to capital. It's going to cost you more interest It's going to require a bigger down payment or a bigger equity position. If you're doing a refi using hard money, you're going to get a lower LTV, but it's a viable access to capital, especially if you only are planning on using it short term. And a lot of them have between 24 and 60-month balloons, so they're not intended to be long-term loan solutions. So even if you had to go that route, you would still want a credit rebuilding strategy that got you back into a quote-unquote normal mortgage environment within that time frame. So great question. I'm here if you need more information. I hope that helped. Hey, Jen, do you have another?
Harper sent this question. Do you think the ridiculous homeowners insurance rate increase will start to hurt the housing market in Florida? My insurance jumped $350 per month. I don't know how people are making it.
Hey, Harper, you're not alone. You are not alone. My insurance did the same thing. 3 of the last 5 years, we shopped the policy because of either big hikes or flat out non-renewal notices. And we're not a claim-rich family. We just happen to be in a desirable area close to the coast, and insurance companies are, fleeing. So this is a great question. People ask me all the time, do I think interest rates are going to kill the market? And I've said no for years because people buy and sell real estate, whether interest rates are 8 or 18 or 2. We've seen it happen if they're applying the proper fundamentals to the transaction. And interest rates passed 8% twice in the last 18 months, 24 months, and properties are still appreciating nationwide. So when I'm asked, is it interest rate? I say no. Well, what do I think it is? I think the sleeping giant for a while has been property insurance. There's no way to know it's coming. Like, for example, if I get a pre-approval for a 6% interest rate on a mortgage and rates go to 7%, and now I've got to get a pre-approval at 7%, well, I know that's baked into my decision. That payment's not going to change. It's fixed for 30 years based on the 6 or 7 or 7.5 or 5.5, whatever rate I get. I can quantify that as a cost. That cost doesn't change. Property taxes change a little bit. If I'm homesteading my property and I'm capped with how much the taxes can increase, I can even calculate that. But the wild card in all of this is insurance. And if you're in a condo or an association, assessments are another wild card. So those are the two things. Do I think it will ultimately? I think it's already impacting it. I think people who are expecting $2,000 policy quotes and they're getting $3,800 are rethinking some of these decisions. So I do think it's already slowing the market. And if you look at the news, some of the news that we've published, it's pretty clear that there is definitely a drag on the market in some of the more disaster-prone areas because the insurance companies are hiking rates, hard and fast, and people are feeling it. And that's the one nobody has an answer to. There's no doubt the insurance companies are paying out billions and billions and billions of dollars. I watched a special the other night on the National Flood Insurance Program, and there was one home damaged by flood. 26 times they rebuilt that home. I know the insurance companies are paying through the nose on claims, but that expense is being passed right down to the consumer. And Harper, people like you and I and the rest of us are feeling it. So great question. I don't have an answer for that one other than I do think it's impacting the market. Hey guys, you hear the music, you know what that means? We have wrapped up another week here at the Mr. Mortgage Show. Man, time flies when I have a microphone. If you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here, same time, same station. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.